In the conversations. These undercurrents, they are obviously very, very significant in nature, but more importantly, they are more structural in nature and not short-term in, or secular in nature, as we would call it. These are the kind of changes that, usually one looks at, from a long-term perspective. They last really long in terms of their positive impact on the economy. And, usually we have seen in the past that they make a launch pad for the next up move in the economic cycle. We do also believe that this constructive changes will benefit India manufacturing or industrial sector also over a period of next 5 to 10 years. Past 2 decades, as we all know, have belonged to services. The manufacturing sector has lost some of its significant space to services in terms of policy responses, contribution to GDP, as well as its share in the broader indices also. And we believe that this is about to change over next about 10 years, between FY22 to about FY30, FY32. And manufacturing, we expect to reclaim its place alongside services in GDP as well as the indices. So without much ado, let me hand over the podium to now to Sachin Shah, my colleague and friend at EIML, to highlight some of these changes and also why they are so important for the longevity of the economic upcycle as we see over next about 5 to 10 years. Over to you, Sachin.
Thank you, Kashyap. Good morning, everyone. A very warm welcome to all of you, and really, really nice of all of you to spend today's morning with us. So, we have a very, very brief, actually a very, very sharp presentation that we have, curated for today's meeting. And, what we have kept into perspective is that there are certain, we are seeing a lot of headlines in the last few months, which has clearly hurt the sentiment of the markets. We have seen the global markets also being under some pressure, and couple of key reasons why why the overall capital markets have been under nervousness, if I can use that word. We've tried to address those points in this presentation. So as you all know, the one of the biggest headlines in the last maybe 1 or 2 quarters now has been inflation. And Amit, can we go to the next slide, please? So, inflation has been coming mainly from the manufacturing side, and also, of course, also on the food inflation. But first, more on the manufacturing side. So all the metal prices, be it steel prices, be it non-ferrous, aluminum, copper, lead, or even some of the precious metals, be it palladium, rhodium, platinum, all of them had actually gone through the roof in the last maybe 6 months, in the first half of calendar year 22. And of course, the rally had already started sometime in the second half of calendar year 21. But like all the cycles, the metals have kind of cooled off quite a bit now. And we have the data in front of you. And today, whatever we are going to talk about will be completely backed by data point, because as they say, in God we trust, but for everything else there is data. So we would like to share each and every data point with you to back our thought process, to back our, our outlook on the markets, right? So from that perspective, if you see the slide here, all the non-ferrous metal prices are down anywhere in the range of 15 to 25% from their average prices. Okay, we are not taking some one single day or something, but if you take because that is what matters for a manufacturer, because they are purchasing their raw materials on a daily basis. From an average of the second half of calendar year 21, or say the first half of calendar year 22. So practically over the last 12 months, whatever the average price has been, if you compare that to what the current prices are, today we are already down in the range of 15 to 25%. So that's a very, very serious amount of cool off. Even the steel prices are down in the range of 15 to 20%. Precious metal prices are also down quite a bit. In fact, in the recent headlines, I also read that the Agri prices are now also before the pre-COVID, sorry, not pre-COVID, the pre-war prices, right? Before the Ukraine-Russia war started, which is the end of February. And from there on, the agri prices had actually gone up quite a bit, the soft commodities, but they have also now cooled off quite a bit, and now they are also at levels which are the pre-war prices. So we strongly believe that the worst is behind us as far as the inflation is concerned, particularly the manufacturing inflation that we had seen, which had completely gone out of whack. And the other very important thing is also, if you see the prices over the last 5 years, 7 years CAGR, with the current prices that they are today, most of these metal prices are in a probably low to mid single digit CAGR. I mean, they have grown at just about 3, 4, 5% compounded over the last 4, 5, 7 years. So that is something what the economies can always absorb. The other very interesting point that we all know has been, and this is, we have created this slide exactly targeting some of the big headlines. And as you all know, that FIIs have been intense sellers in the Indian equity markets over the last 15 months. So practically from 1st April 2021 till 30th of June 2022, which is what the data is there now in public. If you see this 15 months, FIIs have sold nearly 2.5 lakh crores. Right, that's a very, very significant amount, and obviously that has put some pressure on the markets. Of course, the domestic institutional investors have also been aggressive buyers, but obviously the sellers are much more intense, and that's why we have seen some bit of cool off in the markets. But we also believe now, if you see the data points, if you see the period before the 1st April 21, so say from 1st January 2019 till 31st March 21, which is almost good 27 months that we have taken in this period. And any period if you take before 1st Jan 2019, on an annual basis, the FIIs would be net buyers in the range of about 10, 15, 20,000 crores. So not very big numbers before that actually. Right, the big numbers on the buying side also started happening sometime from January 2019 and almost till 31st March 21. So which is good 27 months. Now they have invested 3.3 lakh crores, right? Even if you assume a price hike in this value of their portfolio, that they have invested 3.3 lakhs, about 50%, which means today the market value of that portfolio would be close to about 5 lakh crores. Of that, they have already sold 50%, which is 2.5 lakh crore plus. Right. So typically, if somebody is trying to liquidate their portfolio or trying to reduce their weightage to a particular country, they've already done 50%. Now you don't expect them to go to zero. That's point one. Second, not all FIIs are sellers. There are a lot of FIIs who are actually buyers in the markets at any point in time, particularly in Indian equities. Like I know for a fact that a lot of sovereign funds, whether it's government of GIC, government of Singapore, or it is Norwegian funds, the Norway country sovereign fund, all of them have always been buyers in India, and they will always remain net buyers or net investors in the country. So the point I'm trying to make is the big froth that we had seen in terms of buying, that seems to be completely out of the markets, right? So from that perspective, I think that the big challenge that we have seen from the FII selling, again, the worst seems to be behind us. Probably now the last leg of selling might be happening. In fact, you might have observed that in the last few trading sessions, the intensity of the selling from the FII, which used to be on a daily, say maybe 4,000, 5,000, 6,000 crores of numbers, has already come down to probably 1,000, 1,500, or sometimes even net buyers in the last few trading sessions. So we strongly believe that the data is suggesting that the intensity of the selling is behind us, and from here it should be the last leg. When will they start buying is anybody's guess. I don't want to make a second guess on that, but at least the data is very clearly suggesting that the selling is behind us. The next point is in terms of the fundamental side. Amit, we can go to the next slide, please. So in terms of the corporate profits, right, we have seen an amazing amount of corporate discipline on the balance sheet side, on the profitability side, all coming back very, very quickly. And very, very steadily. As you can see, the last 3 years, the PAT CAGR has been very, very strong. And even when you look at the profit to the GDP, particularly for the listed players, whatever the data is available, is already somewhere closer to the peaks of the previous decade, which means the corporate balance sheets, the corporate inherent profitability is today very, very strong. And they are probably getting even stronger from here on. Actually, COVID played a role of a catalyst where the corporates got into very, very strict discipline about managing their balance sheets, whether it was working capital or even repaying or focusing on their cash flows by tightening their working capitals and repaying some of their high cost debts. And what also happened is that actually the demand came much faster than what they thought. So they got a humongous amount of operating leverage, which has actually made their profitability very, very strong. So that has been another very positive thing in the last 12 to 18 months. So these are the undercurrents that Kashyap was alluding to earlier, which are actually playing out today and probably, getting lost out in the noise that we are hearing about the FII selling and the inflation and all of that. Right. Next slide, please, Amit. Yeah. The other very interesting part, what we have also observed is that on the consumer side, we are seeing that the income levels are also very, very steady and probably growing. Like you can see one here, very interesting data point where we've seen that of the BSE 500 companies, whatever employee cost that they actually disclose has actually grown at almost 13.5, 14% in the financial year FY22. And if we just take the manufacturing companies, the employee cost over there has grown at almost 15%. So again, the cash flow in the hands of the consumers is also fairly strong at this point in time. And we believe that is where the consumption should also actually accelerate from here on, over the next 2 to 3 years. Yeah. Next slide, please. Yeah, this is again very interesting. We all know that the banks have really cleaned up their balance sheets. Particularly the public sector banks and even the private sector banks have now beefed up their capitals very, very strongly for the next leg of growth. And they all are now in the risk on mode, as we call it, where they really want to they want to really increase the ticket sizes, as you can see from the chart at the bottom of the slide, where the higher ticket sizes are actually getting higher growth, whether 25 crores, 100 crore plus. So even to large corporates, and of course the retail credit continues to grow at least 15 to 20%, on the personal loans, both on the housing loan and the auto car loans. In fact, in the last 2-3 days, we have seen numbers coming out from at least the private sector banks, where HDFC Bank has shown 20% plus lending growth. Even banks like Federal Bank have now shown almost 15-16% kind of lending growth. So we are already seeing a significant amount in uptake on the lending side. Again, a very clear indication that when there is so much of lending happening in the economy, again, the money flow will be so much strong that the consumption, investments, everything is actually, we are getting into a virtuous positive cycle. Yeah. Next slide, please. And of course, last but not the least, actually the most important, because as they say, everything is good at a price and everything is bad at a price. After the last 6 months of healthy correction that we've seen in the markets, I think markets have corrected almost by 10% odd. And of course, in this period, the earnings have continued to grow. So on one side, you have a price correction, and on the other side, earnings grow. So clearly the P ratios have become even more attractive, and valuations are now are coming to that comforting zone. As you can see, they are at below the 5-year average. They are below even the 10-year average, and on a 15-year average, which is closer to about 20 times, we are very close to that number. Whereas the outlook on the growth is actually going to be much better than the last 5-7 years, because in the last 5-7 years, we've had quite a few events, whether it was demonetization, GST, COVID, which had impacted our earnings growth quite a bit. And now, as I mentioned earlier, the balance sheets have become very, very strong. The inherent profitability of the businesses have become very strong, because every company has actually made themselves operationally very efficient, and they are getting a good top line or a revenue growth, which is getting them operating leverage. So with the higher visibility of the earnings outlook, today the valuations at this point in time have become very, very, very reasonable. We are in a very comforting zone. So we believe that from here on, actually, Indian economy is getting into a virtuous cycle, and one very strong leg of this virtuous cycle is actually going to be the capex side. And obviously, when that capex plays out, manufacturing sector tends to rock. We have a few slides on that also, which I'll request Kashyap to walk you through on those, on the what is our outlook on the manufacturing sector.
Thank you so much, Sachin, for that those interesting insights. I think it's quite a different way to look at a lot of undercurrents, which are I would say not coming out so pronounced in a lot of readings that we do, but they are significantly important if you look at the growth of the economy as a whole, because most of this things that you have spoken about are extremely long lasting in nature. So they form a launch pad, and that launch pad is extremely necessary in that sense. Like Sachin said, what we believe is that now that we have built that base, which is fairly strong and which could last us for probably next 5, 7, 10 years. Within that, I think one sector which clearly was losing out to its brothers, which was services, is all set to make a bounce back. If you recall in the history, in late 90s or early part of 2000, what we saw in terms of services, which is that the holy trinity or three parts of the ecosystem, which is the service provider or the manufacturer, you have consumer of those services or products or services, and then you have a government which is very supportive of the whole ecosystem. We saw similar thing happening in case of services. Just to give you a classic example, if you look at IT services, in late 90s, we had these companies like Infosys, Wipro, TCS, who were sort of ready to go global. We had consumers in European and US economy which were ready to consume those services, and we had a significantly focused government on that particular sector where they liberalized a lot of forex norms in late 90s, or they came out with some of the taxation benefits which came for a long 10-year taxation benefits in terms of section 10A from the government point of view. Another classic example over here could be banking services, where let's say the manufacturer or the service provider, which at that point of time was the government itself in terms of owner of the PSU banks. In late 90s or in early part of this decade, they capitalized all the PSU banks significantly, brought them back into the shape. You had consumer, which was the baby boomers of early 80s, who were ready to consume those services in terms of retail loans. You had a manufacturing sector who wanted term loans for doing new capex. And then you had a completely focused at that point of time in terms of supporter. You had this, RBI, which completely liberalized the yield curve both on the deposit side as well as on the loan side. So for any particular segment or a sector to succeed, this is the holy trinity which is needed, and we believe that holy trinity is now available in terms of manufacturing sector. Amit, if you could go to next slide. Yeah, and why do we believe today manufacture is in the best of the health that we have seen in probably last 14 15 years? If you look at chart on the left hand side bottom, it shows you the cash return on capital employed. Basically, the accounting, capital ROC less taxes and minus working capital changes. And today, if I look at that number at about 23% plus, is the highest that we have seen, probably since 2005, 2006. As a manufacturer, if I were to look at today a comparable investment avenue available to me, I could do, instead of investing my own capacities, I could do bank deposits, income funds, liquid funds. All those investments today are offering yields which are significantly lower than the yields that they are making on the business on cash basis. And why has that happened? Couple of reasons. One, you have capacity utilizations which are now almost touching about 75%. The fourth quarter number will be available in next couple of days, through the OBICA surveys. And my belief is that that number should cross about 75-78% in that particular, release. Something that we had seen in past only probably in December 2010 over here. The second, factor which has benefited this cash ROC is the tax rate, which has been brought down from about 33% to about 25.2. And if you are putting up a new manufacturing capacity, it's almost about 15%. So that's also has helped. The third thing which has helped this cash ROC is the fact that the government over last about 15 to 18 months has been on spending mode, and which has clearly helped the cash circulation in the system and its consequent positive benefits on the working capital cycle of the corporate sector. So today you listen to any of the corporate conference calls, they all are talking about tighter working capital cycle and easy money availability as such. Whether these positives are reflecting in their own actions from the manufacturer's point of view. If you look at on the left hand side today, the registration of manufacturing company is now almost hitting through the roof. If I look at the proportion of the manufacturing companies as a percentage of total registrations, it's almost highest in last about 5 years or so. On the other side, if I look at, let's say, environmental clearances sought and granted at about 5,500 odd clearances granted, they are almost 10x of what we have seen in the history. So clearly the fact that manufacturers are making decent and more money on their own manufacturing capacity is reflected in the fact that they want to expand their own capacities, because capacity utilizations are sort of hitting back to the peaks of early part of 2010 or 2009. Next slide, Amit. From the government point of view, like I said, for any particular theme to succeed, you need significant support from the government point of view. Couple of things happening over there. One, I already highlighted about the tax rate. So between 1996 to 2002, you saw the tax rate being cut from about 38% to 30%. Obviously, there were surcharges which came in later on, and it became about 35%. But there was a significant 8 to 9% cut in the tax rates. If you look at that point of time, the government capex growth used to be about 4%. In 2003 to 2008 period, it grew at about double digit. If I look at today, the government has already mentioned about the fact that they want to increase the capex intensity to about double digit growth until 25-26. If I look at from the cost of debt point of view, even after about 90 basis points increase in the repo rate, today we are still lower than the peak COVID, pre-COVID repo rate of about 6.5% by almost about 160 basis points. Next slide, Amit. In terms of government's own support, I think what has also happened is that they have already announced the PLI scheme, about 2.5 lakh crore worth of incentives, which will be based on certain targets that you achieve on the revenue. If I look at the targets that has been given to the industry, which is about over a period of block of 5 years, roughly about 40 lakh crores of revenue on per annum basis, that works out to about almost about 8 lakh crores, which as a percentage of today's GDP is almost about equivalent to about 4%, right? So going forward, I think the space that the manufacturing, or industrial sector lost to services in terms of, let's say, GDP, where services expanded from about 42% to about 55 to 59%. I think that's about to change over a period of next about 5 to 10 years, because manufacturing will, sort of expand its own breadth over a period of, next 5 to 10 years. We believe that this PLI scheme is more like an icing on the cake, because per se, because of its own inherent structural changes that I highlighted earlier, manufacturing sector is going to, reap the benefits of those structural changes. PLI scheme is going to be a bit of an icing on the cake, where this benefits will help them to produce more and substitute a lot of things which are today imported, and also in terms of the exports that we could do from India to the global companies. Amit, next slide. What has also helped is, and this is more like a cliche, this has been spoken about a lot in the newspapers as well as in a lot of reports, but China plus one policy is something that we can't ignore. Having said that, I think it's more long-term in nature, and not just because the companies want to replace China with India. If you look at chart on the right-hand side bottom, this is a phenomenon which has been happening since last about 5 years. So if you look at some of the chemical companies and exports of those companies to the global markets, they have grown anywhere between about 15 to 18%. If I look at auto component and two-wheeler industries, the export growth over there has been anywhere between about 10 to 13%. If I look at machinery, which is capital goods, the growth rate over a 5-year period has been about 12.5% CAGR. But if I look at the global trade between the same period, between 17 to 22, the global trade expanded at a very small single-digit number, which means that over a period of 5 years, Indian companies have increased their market share in the global trade significantly through exports, and not just because there is a China plus one policy, which has been taking a highlight over last about, let's say, 2 years or so. Next slide. Very importantly, in Sachin's slides, he spoke about the income growth, which has been making bounce back. I think those, some of those things are interlinked, because when you have inflation, inflation usually finds a feedback loop into wages. wages find a feedback loop into consumption, consumption finds a feedback loop, again into inflation, and so on and so forth, right? So over last about, let's say, 7 years, between 2012 to 2021, what we have seen, and one of our previous slides also highlighted this, is that inflation was completely, sort of missing out here. So if you look at WPI between this period, grew probably at 1 to 2%. In one of the years, we actually had a negative WPI. If you look at between the same period, the personal disposable income, the growth came down from as high as about 14-15% to FY20, which was actually pre-COVID year, at just about 6 to 8%. If you look at between the same period, the private private final consumption expenditure, the growth rate dwindled, dramatically. I think if you are going to see inflation at CPI level at about, let's say, 4.5%, one can safely assume that the personal disposable incomes can grow at about 10 to 11%, a slightly higher double-digit growth. When that happens, it will find its feedback loop into the consumption. I think within that consumption, what we are going to see is that the discretionary will find significantly larger space as we go forward. In morning, I and Sachin were having a classic discussion on this. One of the discretionary spends that the people do is go and watch movies in theater. And Q1 this year, the collections have been about 2,500 odd crores on India basis, which were about 50% higher than what we saw on quarterly basis on the net box office collection. So I think as we go forward, discretionary spends within the overall spends are going to find a significantly larger space as we go forward. Amit, go to the next slide. If you look at, let's say, like I said, personal disposable income growth of about 10-11%, broken up into about 4-4.5% inflation and about 6.5%, let's say, real GDP growth. Today, Wagoner, which is one of the cheapest car available, in India, on road is, it is costs about anywhere between 6.3 lakhs to 6.5 lakhs. Today, an average Indian has to spend about 4.5 times of his income if he wants to buy a cheapest car. Assuming that the per capita disposable income will grow at about 11-12% over a period of next 5 years, he might have to spend, significantly lower, just about 2x of his income. If more banking facilities are available to him, then obviously, some of this discretionary spends in terms of cars gets into, as a part of consumer wallet. Let's say, for example, classic, 350 Royal Enfield bike today is about 1.5x of the per capita GDP. 5 years down the line, it will be just about 1x of it. If I look at, let's say, some of the routine expenditure, which are, more, sort of lower ticket in nature. For example, let's say a 125cc bike, today they end up spending about 50-55% of their income if they want to buy that bike. Maybe 5 years down the line, that will be just reduced to about less than 40%. If I look at, let's say, television, air conditioners, they today end up taking about 40-45% of the income. 5 years down the line, it might take up only just about 20-25% of the income. So I think as we go down the line, and if this works out, and we believe that the probability of it working out is today significantly higher versus what we have seen in the past, I think a lot of these things will find space in the consumer wallet. And when that happens, it's a feedback loop. Like I keep saying that, it will keep finding its feedback loop into the more wages, it will find its feedback loop into capex, so on and so forth. Next slide, Amit. And if I look at the manufacturing, in past, this theme has worked out clearly well also. Like, for example, if I, look at last 15-year period and break this up into three different time frames, 2007 to 2012, 2012 to 2017, and 17 to 22. And we have taken here S&P BSE manufacturing index, which is slightly longer term history. Between 7 to 12, a period which was marked by the recovery post GFC, and there was a significant bounce back in the growth in per capita GDP at that point of time. BSE manufacturing index outperformed the broader index of Nifty 50 by almost 200 basis points. If I look at the next period, which is a period which was marked by a fairly large revenue expenditure by the erstwhile UPA government, which was between 2012 to 2014, and then you had significantly higher inflation between that period. Again, this particular industry outperformed the broader indices by about 200 basis points. I think another way to look at this would be on how many days I could outperform the broader market if I were to buy, sort of bet on this particular index, which is slide on the left hand side bottom. Between 7 to 12, I could beat the market on 55% of days on trailing 12-month basis. between 12 to 17. In fact, I could beat the market on almost about 80% plus of the days is on 12-month trailing basis. It was only the period of 17 to 22 which was marked by demonetization, GST, COVID, fairly low inflation, which disincentivized manufacturers also to expand the capacities, that this particular index underperformed the broader market Nifty 50 by almost about 350 basis points. And my odds of beating the markets were also significantly low, where I could beat the market on only 24% of the days, on trailing 12-month basis. Next slide. And I think we believe that, when one wants to play this particular theme of manufacturing, the ideal way to play would be through a dedicated exposure and not through, probably the broader indices. Because if I look at today, the Nifty 50 or Nifty 500, the effective share of services, like it holds in GDP also, its share in services is almost about 61% in Nifty 50. If I look at Nifty 500, that share is almost about 57%. Effectively, if you are playing on an index fund, or let's say a large cap fund, or even probably a mid cap or large mid cap fund, effectively the exposure that an investor is taking is broadly to the services. Within the manufacturing also, there will be a significant portion which will be allocated in both in indices as well as in funds, in terms of commodities, low quality stocks, which might be part of the index also. So effectively, if one were to look at, let's say, quality industrial or quality manufacturing, the effective exposure that one would get will be just about 30 to 32 odd percent if one were to play this theme to large cap funds or index funds, or probably large mid cap funds also. So I think in terms of investor exposure, it makes a lot of sense to have a part of their portfolio as dedicated exposure over here. And by itself, it's fairly diversified. It's not a concentrated bet that one is taking, because if you look at Nifty India Manufacturing Index also, it's broadly diversified in terms of weight, where automobiles is about 20, capital goods again takes about 20% weight, pharmaceutical is about 17, metals, chemicals. These are all large 8 to 10 or 8 to 15% weights that some of the 7 sectors that take up, and it's a fairly diversified index per se as such also. Amit, next slide. From our point of view, where we have this Emkay new vitalized India strategy, which is particularly banking on the manufacturing theme. We already have a model portfolio which we have started investing in. One thing I want to highlight over here clearly is that at Emkay, we have already highlighted about our Emkay quality model earlier with you, friends, and which goes into also this particular portfolio also. If you pick up any of these names, it will be very difficult to probably find any loophole or any particular negative points, at least about the promoter or the management of any of these companies. The second thing I want to highlight about any of these companies is that if you pick up any of these companies, these are all scalable models. So whether it's iShare, which is now expanding its area of exposure into global geographies, whether it is, for example, Timken India, which is now getting exposure to global markets through its own parent, whether it is Elecon Engineering, which is into gear business and trying to expand into American markets, which is almost 10 times of India gear market, whether it is Endurance Technology, which is expanding into newer products within the two-wheeler segment, whether it is CCL Products, which is now expanding itself into Europe and US markets in terms of manufacturing contracted coffee. You pick up a name and they are all scalable models. So whenever we invest in any companies, two things are very important for us. One, obviously the promoter should have an impeccable integrity, and point number two, the models should be really scalable. Whether it is global or local, it has to be a scalable model. It can be a global model also for us. If you look at this portfolio, there is a fair bit of diversified exposure, both in terms of domestic consumption, where the exposure ranges anywhere between about 14% to almost about 100% in some of the companies. We have taken a fair bit of exposure to companies which are into export segment also. Some of our companies also have their own manufacturing base outside this company, and they are very profitable franchises. If you look at some of these names, they have already gotten approval under PLI schemes. Some of them have applied but yet to get an approval under PLI scheme. But like I said, PLI scheme for most of our companies are just going to be icing on the cake, and it's not going to be the the structural change that we look for any particular company to take benefit from. For us, like I said, these are the two things which are very important: promoter integrity and two, the scalability of the business. Everything else will, just fit into the jigsaw puzzle. Next slide. So here I will, we'll end the presentation. Vikaas, if you want to add anything to this, you're welcome to, sort of add, and then we can move on to the Q&A session.
Thank you, Kashyap and Sachin. I think this was quite concise, quite crisp, and to the point. I don't have any further things to add here, except just to share an experience. I think somewhere you were mentioning about, the preponderance of services in client portfolios. In fact, I've been meeting a lot of people. This holy trinity which you talked about, which happened in the 1990s, 1999, 2000, which has led to growth in the software services, effectively means that most people's personal portfolios today have a lot of winners from the services space, which means that what happened 2 decades ago has led to a probably lopsided weightage for services in one's portfolio, for the right reasons, of course, which begs the question that if one tends to focus more on the manufacturing sector right now, so 20 years down the line, you might see, 20 years again, and just correlating, 20 years down the line, you might see a similar sort of thing in your portfolio. Net, I think the fact that the time for manufacturing has come has been underscored time and again, which is what I think I'd just like to highlight. Otherwise, I think your presentation was pretty okay. No problem. You can just take the question answers from the team.
So thank you, friends. We can move on to Q&A. You have a Q&A chat box which is available in case anyone wants to put up questions over there.
Or you can directly ask.
Or you can directly ask the question.
I see a lot of friends in the fraternity. Please feel free to just ask. I just see Nachiket Kilkar has just asked a question. Can you share some thoughts on the FMCG sector? What's your outlook here? Not surprising, considering what is happening over the last few days. Yeah, please go ahead, Sachin and Kashyap, take that question, please.
Hi, Kashyap, go ahead.
Sure. So broadly, I think, like I said, in terms of where we go from here, whenever we see this kind of, like what we are expecting, expansion in terms of the disposable incomes, usually so FMCG obviously will grow, but I think what will grow faster is the discretionary spends, and that's where I think the larger part of the story lies. Having said that, in which case our inclination is more towards the discretionary spends and not the non-discretionary space, as we call in FMCG sector. So I think that's broadly the outlook at this point of time. While we believe that FMCG will grow, what will grow faster is discretionary. And if you look at our portfolio, that's how our portfolio is also aligned.
Yeah, and if I can also add, Nachiket, so FMCG as a sector clearly is like an evergreen sector. With the demographics of in the country that we have, there will be a certain basic growth of maybe mid to high single digit growth of volume growth, and of course the companies also in that sector are very, very solid companies. So many of these large MNC companies. We also have some very large reputed domestic family houses who have actually created some amazing amount of brands in the last maybe 2 to 3 decades. Whether it's Marico, whether it's Dabur, whether it's Pidilite, or whether on the MNC side, you look at Hindustan Lever, Procter and Gamble. So, all these companies have done wonderful and they'll continue to do well. I know the challenge, of course, as investors is, as I mentioned earlier, everything is good at a price and bad at a price. And that is one dilemma that we always face as fund managers. Because obviously when investors are parking funds with us, they expect certain returns. And what we need to figure out is that what is discounted in the price and what is not discounted in the price. And that's one dilemma that we always face. So, and particularly with the FMCG sector, that has been a very, very big challenge because the valuations of most of these companies are not really at a place where we can expect some high double-digit returns. Yes, they will give you returns, but they will be probably in the high single-digit to low double-digit kind of returns. So it depends on the profile of the investor. If the investor is extremely defensive and he just wants a return which is probably marginally better than the fixed income, maybe FMCG is a good sector. But for investors who are looking at probably 50% to 2x kind of returns over the fixed income, maybe we will have some better sectors like as Kashyap was alluding to.
I think Pratik from Deccan Herald is asking a question on. He says we saw some signs of semiconductor issue easing out, reflecting in the PV automobile sales figures. Do you expect the automobile industry to finally outgrow the pre-pandemic figures? Also, can we expect the rural demand to pick up in the automobile industry?
Yeah, so Pratik, clearly we to some extent we are already seeing that number of pre-pandemic outpacing, but in some of the companies or in some of the few kinds of vehicle, not every type of vehicle. So we have already seen that expansion. So for example, if you look at Eicher Motors, the monthly numbers are already if not much higher than the pre-pandemic number, are sort of on monthly basis trying to touch that pre-pandemic number at about 65,000 odd, 64,000 vehicles. So we clearly see that looking at the bookings that Maruti has been talking about, let's say new Brezza, or Eicher has been talking about in terms of new Classic 350, there is a significant demand which is today suppressed because the supply chains are not back to the pre-COVID level. So as semiconductor issue eases out, and point number two, we have already seen a lot of these metals which are used in all these automobiles, which is aluminum, which is steel. In terms of exhaust, because of BS6, you use a lot of rhodium, platinum, and palladium. All these prices have now corrected. So I think both these things will provide a significant boost to particularly automobile industry as we go forward. And I think which is where you will see a significant pickup in terms of volumes. In terms of rural demand, I think a couple of things will have to work out. One, we do believe that if you look at cash flows in the rural space, because of whatever has happened to the agricultural commodity and the fact that government has spent decent amount of money last year in terms of Manrega, the cash flows are today very decent. The only issue over here is that there is a significant base effect in terms of large growth that we saw in rural space last year, right? So you have to outpace that growth, which at points of time, because of the unfavorable base effect, also gets really difficult. So I think as we go forward, if rain gods smile on us as much as they are doing today, I think you will see a bounce back over there, and they will equally participate in the overall automobile industry recovery as we go forward.
Kashyap, I think
Yes,
sorry Sachin, please go ahead.
Yeah, sorry. So Pratik, if I can add to that, is that everything that Kashyap said is absolutely what we believe in. And the proof of the pudding is in the eating. So our mouth is where our money is. So like as Kashyap mentioned, has showed our model portfolio, you must have observed that we have a significant overweight on the auto and auto ancillary side. So we strongly believe that the outlook for the auto and auto ancillary is extremely positive over the next few quarters to maybe couple of years. Yeah, Vikaas, sorry.
Yeah, so I'm just saying that while Kashyap was talking, the natural corollary to his answer was already popping up in terms of any nifty year-end target, whether one should enter the markets. This is Sundar Sethuraman asking. And interestingly, he's asking for 3-year PAT CAGR. Can you also throw some light on the revenue CAGR and how much is Divine Revival contributed to the PAT growth? I don't know, Kashyap, whether you have covered this, but I think
no, I haven't covered, but I can give him these numbers. Just give me 1 second. I can give him the numbers, exact numbers.
Yeah, Kashyap, one data point, if either of you can also give, there has been some news in terms of pickup in the manufacturing sector. Some data has just got released over the last couple of days. In case you have that handy, you may want to just talk about that also. 8 core industries, coming up with some very good numbers.
So I'm not sure, Vikaas, the number that you are talking about, maybe if you have some highlight as to there, but the number that, Sachin gave was not PAT CAGR, but that was the ratio of PAT to GDP, which expanded from 2.5% to almost about 2.8% to about 4.5% of GDP. If you look at PAT CAGR cumulatively, the number let's say pre-COVID to post-COVID, or let's say FY20 to FY 22 should be roughly about, on a 2-year basis, the earnings would have grown at on a 3-year basis almost at about 22 or 23% CAGR. Revenue CAGR, I don't have the number exactly, but because it's PAT to GDP ratio, obviously GDP growth is the revenue denominator that we have used over here. And if you look at nominal GDP growth over last about 3-year period, would be in single digits, which means that the growth in the profitability, like Sachin said, was more an outcome of operating leverage, more an outcome of financial leverage, and more an outcome of the tax rates, the cut that we have seen between 2018 to 2022. So this will be the 3 primary reasons for that, profitability growth, rather than probably the revenue growth. Because like I said, the denominator here in PAT to GDP ratio is GDP, right? And GDP, we all know at nominal basis has grown at single digit, whereas the PAT growth has been a fairly high double digit number. So it's obviously an outcome of operating, financial leverage, and to some extent tax rate also. Nifty, I don't know. I would myself shy away from giving a target over there. But your second question is very relevant, which is, is it good to, sort of enter the market as the valuations are close to their long-term average? I would sort of say claim that we are no expert in catching the bottoms, and we are no expert in catching the tops. All we can say that at a certain point of time, the market gives us comfort in terms of valuations. And, obviously in a lot of our schemes per se at EIML also, we give our customers or our clients, a leeway to invest in systematic transaction plans. So, obviously one could do that systematic transaction plans as one does SIP in mutual funds also. So that's how I would handle this. But I would say nobody is an expert in catching the bottoms and nobody is expert in catching the tops.
I will just like to add here, Kashyap, because of this point here. Like I said, I've been meeting a lot of clients and a lot of family offices and distribution outfits. Even 3 months ago, there was this question of whether we should invest now or we should wait. But now I think the sentiment is turning very rapidly to yes, we should invest. Let's see what is the right opportunity or what time to invest. So I think the mood is turning neutral to positive right now, which is where this 10 by 10 thing which you talked about, 10% over 10 weeks, something which we exclusively offer, is something which people are liking. People are saying that, okay, we want to take a call on the markets. We believe that the markets are close to very fair valuations. So let us just stagger it in, just in case there are some other opportunities we can take advantage of. If there are some dips which you can take advantage of. Year-end target, I'm sure that neither of you would like to take a guess, but I'm extremely positive, in terms of how things will pan out over the next 6 to 9 months. And I just like to leave it at that. I think people investing now are not going to regret. This is probably a time and place where if you invest now, you look back and said, okay, I did a good thing. I did a smart thing. Just for the record, my predictions are not entirely off the mark. I made the same statement in April 20. So there you go.
So anybody wants to ask a question, you can simply unmute yourself, or you can put it in Q&A chat box or a normal chat box.
I'd just like to, in case there are no questions, I'd just like to tell, all the people who've attended this conference. I think I'm seeing so many articles. A lot of you are writing out there, encouraging people to look at a longer term perspective, looking at investing in different asset classes, trying to contain all the emotional flux which is happening. I personally enjoy quite a lot of articles. So thank you so much for helping us as a fraternity. It makes our life that much more easier when we go and talk to clients. It's very easy for me to pick up something from a Twitter handle or from a press article and just show it to the client saying, "Dekho, ye to press mein bhi aaya hai." We are not the only ones saying it. Even the media is saying that. So thank you so much, guys, for supporting the cause of the industry. And, I think good times are around the corner. So on that note, I think, thank you so much. Kashyap, Sachin, any final comments you want to make?
Oh, I would just say thank you very much for your time, and please get back to us if you need any more data points.
Thank you.
Thank you so much,
ladies and
everyone.
gentlemen. Thank you.
Thank you,
Thank you so
everyone.
much.
Thank
Bye-bye.
Thank you.
Thanks. Bye.